Well, after a two-day testimony from the Fed Chair Jerome Powell, investors are digesting a second inflation report this morning, too. And it will help guide the central bank's interest rate path, which does impact the cost to borrow money. So joining me now with more is Mark Hamrick. He's Washington Bureau Chief and Senior Economic Analyst at Bankrate. Mark, great to have you on the show today because already this week we've had a lot of data and commentary to digest. What do our viewers need to know?
Good to be with you, Kristen. Inflation has reared its ugly head once again in the latest readings, both the CPI and the Producer Price Index out this morning. The president did not eliminate inflation on day one of his administration, and I think the outlook is that we're going to be seeing inflation stick around for a while. I would say both reports were disappointing, and the Fed is not going to be thinking about cutting rates in the near future, given the fact that we have seen this surprise to the negative side with respect to inflation.
Underneath this headline number, Mark, are there particular categories that stand out to you where price gains are more significant than others?
In the early days of the problems with inflation, Kristen, it was largely goods-driven issue. Now it's really reverted more so to the services side, but that was one of the remarkable things I think about the consumer price index was there really wasn't much of a safe haven anywhere in the report with respect to inflation. We saw it in food, we saw it in energy, we saw it in shelter, for example. And that gets to the stickiness of this. We know there are some things that are sort of outliers or standouts within the report as well. Some of them are particularly irritating to consumers, such as the 15% monthly increase in egg prices, up 50% over the past year. Motor vehicle insurance is an issue. The natural disasters that we've had, both in California and in the South, have led to increased demand for automobiles, just replacing those things. And that, of course, relates also ultimately to the cost of insurance. So I wish I could say that there was some area that was significant for consumers where it's not happening, but it's happening in more categories than where it isn't. The exceptions are areas like cell phones, televisions, consumer electronics, apparel of late. And that, frankly, is almost inconsequential.
So with these inputs, Mark, how should consumers be responding?
Well, I would love it if people both had the capacity and the desire to save more money. We saw in our most recent Bankrate survey that only 41% of Americans could pay an emergency expense of $1,000 or more from savings, and that's interrupting 3 years of improvement on that front. And we know that other data points to a lower saving rate. And we know that a certain component of the population has been drawing from the savings, if they had it, to help make up for affordability challenges. The good news in aggregate is that wage gains are outpacing the rate of inflation. But when we see, for example, with the CPI, the year-over-year headline change of 3% and slightly above that in core, that's narrowing that gap, unfortunately, between the wage gains. And your results, so to speak, speaking to the public, may vary. You may not be enjoying the same wage gains as someone else, or you're starting from a lower level. As we began the year, for example, 21 states, dozens of localities raised their minimum wages. And obviously, if you're making a minimum wage, then you're at the lower end of the wage and wealth spectrum. So you're lifting boats sort of from the sand, so to speak, with that. So this is consequential in the sense that, as you know, Kristen, expectations for a Federal Reserve rate cut keep getting pushed out. And, you know, it's not even, we cannot ignore the chance that the Fed doesn't even cut again. And, you know, we'll just have to see how this game plays out.
So, Mark, I'm hearing that you recommend consumers save more, certainly based on your data, that covering an emergency expense would be hard for many Americans, that is. So with this inflation data, commentary from the Fed, and of course pricing in what the market sees, what is your expectation for inflation ahead with the new administration in the mix as well?
I think the risk is that inflation remains sticky. The hope is that it does not. By the way, just add on one thought about the savings, and that is many people fail to reach for the highest yields that are available in savings accounts. So, for example, for a high yield savings account, not a CD, you can get 4% of an average return, which is above the rate of inflation. So, just sticking that one idea out there for people. Obviously, the Fed's going to stay restrictive, and they believe that rates are currently restrictive. What we do not know, Kristen, of course, is how inflation might be affected in the future by the tariffs that are sort of infiltrating the headlines every day. And that, by the way, is affecting inflation expectations, which is a dangerous thing because consumers are starting to believe that inflation is going to stick around for a while, and that can lead to changes in behavior that tend to reinforce that. And if those expectations became unanchored, as the Federal Reserve says, then they know they would have an additional problem. So that's another outlier that's a risk.
Mark Hamrick, always good to get your take. Thank you so much for joining us remotely. Mark's the Washington Bureau Chief and Senior Economic Analyst at Bankrate.
Thank you.